So in today's episode of the Morales Group Show, we're going to be answering the question, what is a Delaware Statutory Trust? We're going to talk about if you want to sell your property because you don't want to actively manage the property, you don't want to pay the taxes, you still want the income and don't want the headaches, the Delaware Statutory Trust may be a good solution, otherwise known as a DST. Today, we're going to be talking about what is it, how does it work, what does the process look like, how do you underwrite them, and then what are the risk and reward to help us with that? We have Lyndon Grey with Atria Wealth Solutions. Welcome to the show, Lyndon. How are you?
I'm well, thanks. Thanks for having me. Appreciate it. Hello, everyone.
So let's just jump right into it. So for our viewers that don't know, what is a Delaware Statutory Trust, also known as a DST?
So let's back step for a moment. Most people know what a traditional 1031 is, and that's been in the tax code for 100 years now, over 100 years. It celebrated its 100-year anniversary in 2021, way back when farmers were growing crop on a small farm and wanted to grow more crop on a big farm. The government basically said, let's incentivize that community, in general, the whole real estate community, and say, if you wish to move up and create a bigger farm to create more crop, we're not going to tax you. And the net benefit was a benefit for the state, for the community, et cetera. And it incentivized sellers to basically move up, create more, buy more land, create more crops, feed more people, et cetera. So fast forward to 2004, a lot of the big realtor organizations and the attorney market, et cetera, lobbied Congress to come up with a subset to that, or like I like to say, the cousin to that 1031. And in 2004, legislation went through Congress and it became law and part of the IRS code that basically says a DST can be utilized, a fractional percentage ownership of a portfolio, to satisfy a 1031 exchange. And so that's how we got the DST. It's in the legislative books, it's on record, so you have legal footing to stand on. It's not some pie in the sky situation where you'll be audited a year from now and be in bad graces with the tax authorities. So that's a legal foot that it stands on. And it allows for the passive approach to an exchange. It's not for everyone. It's ideally suited for that client as they get older, 60 plus. They've acquired a lot of properties in their 40s, 50s, and now they're about to kind of unwind. They manage them themselves. They call a handyman when something was broken, and so on and so forth. They were very hands-on. And so now they're looking to spend time with grandkids and travel without being interrupted on their trip about a busted water heater and who do I call for the leaky roof and so on and so forth. However, they don't just wish to sell those assets and pay the taxes just so they can free themselves up of this property. They still want to have the benefits of tax deferral, and that's where the DST comes in. They're able to sell an asset, and instead of looking for another property to exchange into physically, we show them several portfolios that they can go into. Amazon distribution facilities, multifamily, self-storage, and they can say, you know what, this million, I like put a third in house in self-storage, a third in multifamily, a third in our Amazon distribution portfolio. And by doing so, they have great asset class diversification, industrial, storage, multifamily, and then they have geographic diversification. So they're not just beholden to one state and one economy in that state. They're now spread amongst multiple states, multiple asset classes, and they're getting cash flow coming in, hitting their checking account on a passive level. And the main thing is they still keep their tax deferral intact.
Got it. So basically, ideal client is basically somebody looking to simplify their life. In other words, somebody that's reached the point where they don't want to actively manage. At the same time, they don't want to liquidate the investment because if they do, they're going to pay a bunch of money in taxes and still would like the income from that, basically that. Now, what does the process look like? So most people watching this podcast know what a 1031 exchange is. They know the timelines for the 1031 exchange. Let's say that in a regular 1031 exchange, you have 45 days to identify the property and then another 135 days to close on it. Is that the same process there with the Delaware Statutory Trust where you have 45 days um, to decide which one of the products you're going to go to and then an additional 135 days to close, or is there anything different there?
Same template. This is just a passive approach. So in the direct world, the agents go out with their clients and identify a couple of properties to exchange into. In the DST world, you still have those timelines. However, you remove the stress of trying to find something in 45 days because these portfolios have already been vetted, they've been financed, they've been put together, and basically open up to the 1031 community. So they're already on the shelf. The analogy I like to use is you go to a restaurant and you look at the menu and you see the steak dinner, the fish dinner, and the vegetarian dinner. They're already there. They have it in the back, ready to bring it out for you. Same thing with the DST world. As an advisor, we have the different portfolios on the shelf. I get a call from an agent or the client. I'm in escrow. I'm about to close in 2 weeks. I don't want to look for another physical property. What do you have? And then I go through what portfolios I have, and then we select. So it kind of makes the 45-day window very uneventful because they're not up against the clock trying to shop for a property and get financing and all of that. That's basically I send a couple of emails and we discuss them in a Q&A and we decide which portfolios to go into.
Got it. It could also, if I'm understanding you correctly, be used like, let's say that for whatever reason you're getting close to that 45-day timeline, you haven't been able to find a property. The DST might be a way to invest, or if for whatever reason the property that you're considering for whatever reason doesn't work out in that 45-day window, a Delaware statutory trust could almost be like a last minute solution to defer the capital gains and not pay the taxes as well too. So
Exactly.
what type of distributions do people have? Like, are these monthly, quarterly? Does it depend on the specific product? And also, like, what are some of the like common returns? Obviously, whenever we talk about returns, it varies. It's not a guaranteed return, and it varies by product. What does that look like?
So the general numbers in terms of your monthly cash flow, these are monthly dividends that come in because in essence, we want the DST to mimic your real life situation. Someone coming from a 10 unit in Hollywood that they own for 20 years with monthly rents coming in. We want to then, when that goes into a DST world, we want to still give them that monthly cash flow. And so it's monthly, and the dividends are coming in around 4 to 5, 5.5 in that range, depending on the asset class. So pre-COVID in 2019, I remember doing some portfolios for clients. They were in the 6.5 range on the net lease space.
Wow.
And of course, you had COVID, you have inflation, you have higher interest rates that squeeze your yields down because cost of capital is more expensive and in labor and goods are more expensive now, et cetera. So net lease now tends to be the highest in terms of the coupon, and that's in that 5.5 range. It used to be in that 6.25 to 6.75 range pre-COVID. And then all other asset types like self-storage, multifamily, they tend to be in that 4.25 range. And then industrial, like the Amazon distribution facilities and FedEx facilities, they tend to be in that 3.5 range for the most part.
Got it. Okay. And then are you allowed to invest in a Delaware statutory trust? Like let's say some people as they get older, they don't want to have loans, outstanding loans on a rental property, and they don't want to be responsible for a mortgage. They don't want to be responsible for paying a monthly for receiving the monthly rent. How does that work if you have debt on a property? Can you still do a Delaware statutory trust? And how does that process work if you do have debt?
Indeed, good question. So the debt, most people, 80% of people have taken equity out over a period of time to invest in other properties and so on. So by the time they go to sell, they do have an LTV of 20, 30, 40, 50% on that property. The beauty about the DST world, they know the market is coming to them with some debt. So when they put a portfolio together and they go to the bank and get a loan on that particular portfolio with it and come out with an LTV of 40, 30%, et cetera. As someone comes in with a property with debt, that portfolio can now absorb their debt, and that debt on that client's portfolio or FICO score credit report drops off and no longer shows up on their report because by law, the DST world in the legislation through Congress, it says the sponsor or the owner or the provider of that DST portfolio will be the one to place the debt on that portfolio. And other people coming in with their exchanges can basically ride the coattails of that portfolio's debt, and their equity absorbs the debt that they're coming in with. So, for example, someone with $1 million sale had 300,000 mortgage on it. I get the call that they're selling, they're in escrow, they're about to close in a week or two. The 700,000 equity comes into a portfolio that has an LTV of 30, 40%. That 700,000 is assigned a level of debt equal or greater to the debt that was paid off during escrow when their escrow closed at 300,000. So now they come in with that 700,000 into a DST portfolio. It's assigned a level of debt that will match their $1 million or more property value that they sold. 1 million was sold. By law, the DST or the 1031 legislation says like for like, equal or greater. That includes debt and equity. So the debt and equity has to be accounted for in order for your 1031 to be in good order. If you only did the equity, went into a cash deal, no debt, you would be on the hook for the 300,000 in terms of taxes. So it has to be accounted for to have a smooth 1031 transaction.
Does this mean that or like let's say there's two different clients, right? One of them has a property paid off and the other one has 50% loan to value ratio. Can they invest in the same fund, or could they only invest in funds that have no debt or that have a 50% LTV value?
Yes, they can invest in the same fund. The thing is, some clients might say, I don't want that, so let's look for all cash deal, and that's fine. The client who doesn't have debt, another client who doesn't have debt might like the idea of having some debt. I had a client in Malibu who had a lot of properties and he's owned them outright. So he was seeking more debt so he can strategically use that debt to lower his gross income and give some tax advantage because of that debt being on his books, where most of his properties were just owned fully out clearly with no debt at all. So the debt can be an enhancement to someone, giving them better treatment for in terms of tax avoidance or tax advantages, whereas no debt they would be have more taxable income because as you notice on your mortgage statement or your 1099s, that first line, mortgage interest deduction, is usually the first big line that comes across. So if you did 30,000 in income and the mortgage interest deduction says 5,000, then your taxable amount drops down to 25,000. So the debt can be strategically utilized and to the client's benefit But for those who insist on no debt at all, there are cash deals out there that they can utilize. But it doesn't prohibit someone who has a cash deal to go into a debt deal if they want.
So basically, that's on a case by case type of basis. And also, like, you can be strategic as to whether you get debt or no debt. But if you're coming into it with debt, you have to have a minimum debt allocated of that percentage, basically. So if I'm coming into it with a 50% LTV, I have to get a minimum of 50% LTV. Now, does that mean that my loan gets paid off, right? The other loan that I have in the sale, it gets paid off. And then the new loan is got by the sponsor. That's how I'm able not to have new debt on my personal credit report, basically. So what I've done is I've eliminated any personal debt under my name, and now I'm just receiving a return on my equity, 4 or 5%, whatever it is, paid out monthly. What is the maximum LTV? And the reason I ask this is I have clients sometimes that maybe have refinanced their properties and maybe are at a higher 80% LTV, and now they're at a point where, like, man, maybe I shouldn't have refinanced. I no longer want to manage this property. What are some of the max LTVs that you typically
I've
see
seen
in
some
Delaware?
max LTVs up to 80% on
Wow.
Amazon distribution facilities. And there was a unique LTV, believe it or not, the Las Vegas headquarters and training facility in Vegas was a DST or is a DST. And that had a high LTV, I think about 76%. The thing about the high LTVs, the main focus there is where can I get a DST to absorb my debt? That's your main focus. It's no longer, I'm looking for good income. I need a 4% or 5% because there's a trade off. If you're looking to reduce that debt or account for that debt in an exchange and you're looking for a high LTV, you're not going to get a 4 or 5% income either. So it's one or the other. So the high LTVs usually don't have income to pay out. They're called zero coupon, meaning no dividends, because the main objective there is really to absorb a large debt that someone is coming in with and not about the income.
Got it. Okay. Now, in a DST, so in a traditional, like, let's say I do a traditional 1031 exchange, I basically get depreciation, I get an interest write off, I get appreciation. How does that work in a Delaware statutory trust? Meaning, do I still get those? I get the step up in basis as well too. Meaning, when I'm no longer here, um, my kids get the step up in basis. Can you talk about that?
Sure. So yes, you are entitled to all of those things that you had in a traditional 1031, step up in basis, depreciation schedule, etc. All the write-offs that come with owning real estate. Because even though you're a percentage owner, you're still an owner. So you're entitled to, if that portfolio made a 20% return and your $1 million came into that portfolio, you're entitled to 20% of that. So your million becomes 1,200,000. So even though you're in a passive position, you're not forfeiting those benefits that come with owning real estate. As a matter of fact, in several cases that I've done in the over the years, as I sat there with the clients and we went over the income, they would look at me and say, geez, that income is better than I was getting when I had my property. And if you, as we drill down some more, you find out they've had the property for 20 plus years, long-term tenants, so they become friendly with the tenants, never really raise the rents. And by the time they wish to raise the rents, the laws in terms of rent control are against them and so on. So once they come into this portfolio and they also have no mortgage and no, they've exhausted all the depreciation on that property. So even though they're getting less rents, it's 90% tax now, other than the miscellaneous gardener or minor repairs that happen on the property in terms of the write-off. So when they come into the portfolio, they pick up the depreciation, the write-offs, the mortgage interest deduction. So that 6,300 that he's getting, he might only pay taxes on 4,400 of it. as opposed to, so you're putting more monies in your pocket when you come into a DST portfolio.
Got it. So you still receive all the same benefits as you would basically from
Exactly.
a
You
actively
don't
owned property.
forsake any of those. You're entitled to them. The
Got
appreciation,
it.
you get that as well.
Okay. So what is a step up in basis maybe for somebody that doesn't know this?
Good. So yeah, the step up in basis is a great tool. However, the onus is on the individual to present that information. Someone passes away, even though they bought a property 20 years ago for 200,000, or stocks of Amazon for $10 or whatever. As they age and they pass, the step up in basis says date of death is when that position will be priced. So if that property is now worth 2 million on April 1st and someone passed away then, for tax purposes and estate purposes, valuation of the estate, that's the date that they take the value of that asset. So April 1st, 2 million, bam, that's the 2 million. So your beneficiaries, your heirs, your grandkids can inherit that asset free of taxes. And that's usually the pushback that I get when I'm discussing the DST, especially for someone who has never heard of it. They throw their hands up and say, "What's the catch? I know there must be a tax. I'm going to pay taxes sometime." And I tell them, not really. You really don't have to, because you roll these assets over and over, and someone passes, bam, you get the step up in basis. Your grown kids, grandkids inherit that asset. So it goes to basically the legacy that you would leave. You're passing wealth to the next generation without forfeiting 40 cents on the dollar, 30 to 40 cents on the dollar to Uncle Sam. That's good wealth that can be help grandkids get to college funding, etc., buy their first home and continue to build that legacy of wealth. And as Jose knows, owning real estate is definitely a foundation piece in terms of just
Yeah.
building wealth.
How does that process work as to the date of death valuation? I know, like, for a traditional property, like, I get asked to do date of death valuations from attorneys all the time. But like in a Delaware statutory trust where maybe it's like a large commercial, does that mean I have to pay for an appraisal of that large commercial and a building and then basically get the allocation of whatever I'm at? Or how does that get handled? Is that something that the DST typically provides me with? Or
Yeah, they have certain departments within their within the DST world, whether it's acquisitions or dispositions and valuations and so on. So once they see that death certificate and it's a DST, then certainly they have to get some kind of valuation on that for estate purposes. However, the property is not liquidated at that time because the DST world, you have to wait for the sponsor to go full cycle with that asset. That could be 4 to 6 year window, 5 to 7 year window. At that time, that's when you get a distribution of those proceeds. So in the estate planning world, we've seen clients come to the DST as a solution, especially if they have 2 or 3 kids and they have 3 or 4 properties. I've seen some ugly in-house fighting amongst families when mom and dad has passed and they've left these assets to them. These kids have their own trajectory and their own careers and so on. And now they have to be stuck with managing properties and they're not getting along because one person wants to sell it, one person doesn't, one person wants to get a friend in there, and it becomes a headache. So the DST world basically forces them to get a stream of income to each person. If it's 2 people, one half, 50%, 50%. If it's three, a third, a third, a third, until the portfolio is sold. And then each can get their separate amount and go their separate ways. And one can say, you know what, I want a 1031 back into a physical property. Or I'll take my share and roll it into another DST. I like the income. I live overseas now. I like that income just hitting my account, etc. So you have more flexibility and then you have less infighting amongst family members.
Got it. When is the holding period determined? Is it determined at the beginning of the investment? Is it determined uh, towards the end of the investment? How does somebody know what the holding period is going to be? And do different um, funds have different holding periods?
Good. So the holding period is not determined beforehand. Reason being, it's not like a CD. You go to the bank and say, yes, I would like a 3-year CD, and you know the date that it's coming due. Real estate is based on what's happening in the economic markets and so on, the macro picture. So a provider of a portfolio is not going to say, okay, we're issuing this today, 4 years from now, on this day, we're selling it. Because what happens is that time you might run into a COVID situation or an 08, 09 crisis where the banks are failing and there's turmoil in the economy. So you want to give yourself a window, and 4 to 6, 5 to 7, depending on the asset type. Some assets go full cycle sooner, like self storage, multifamily, versus industrial. They tend to go a little longer, 5 to 7, etc. So the providers of these portfolios give themselves some wiggle room, because imagine having a property in '04 and you're saying in '08 we're selling this property in April or March or whatever. And that's when the economic downturn started. And so if you set that date, you're going to have people coming up and just lowballing you. You're never going to get the price. So you had it in '08. You might have had intentions to sell it in '08 or in '08 or '09. You bought it in '04, but then the crisis happened in the economy. So you sit on the asset. You service the asset. You continue to rent rolls out to your clients, the income, and then you wait for a better opportune time to sell that asset. So they're never going to pin themselves in a corner by saying they're selling it on this day, because it could be a bad macro environment, and then they're locked into a low price.
So they give somewhat a range. You have somewhat a range. Like our goal is to sell within 5 to 10 years, somewhere in
Exactly.
that range. Obviously, that can change at
Yeah.
any given time. And then if they sell sooner than what you wanted, you have the option of cashing out that 1031 exchange, or you have the option of reinvesting into another Delaware statutory trust. What happens if somebody, like, let's say that the range is 7 to 10 years, and let's say that for whatever reason I come across something where I'm in a pinch and I invested $500,000 of equity in a DST and I need 200,000. Is it illiquid at that point, or are there any options at that point?
Yeah, that's one of the two negatives to the DST world. That's why in my job as an advisor, it's up to me to ask the key questions. What kind of liquidity do you have outside of these proceeds that are being potentially exchanged? Do you have a pension? Do you have IRA, 401k? Do you have brokerage accounts? Do you have CDs at the bank? If the answer to those questions is no, 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 and someone has this $1 million from a sale of a property, then I might say, you know what? I think you need to retain 300 to 400,000 of those dollars and pay taxes on it, and roll maybe 500 to 600,000, because the last thing you want to do is commit the full amount into a DST, and then a year or 6 months into it, gee, I need 50 grand. We have this situation. We don't want that, because the DST world, it's not like stocks and bonds where you have ample liquidity. Like you have 1,000 shares of Apple and you call your advisor and you say, sell 300 shares, bam. That's no problem. In the DST world, it's not as fluid as stocks and bonds. And you commit to real estate. It is hard asset real estate, even though you're in a passive position. So the provider of that portfolio will shop that portfolio at some point to institutional buyers such as insurance companies, pension funds, endowments, and so on. And until then, you won't have liquidity. However, they are in this business to make money for their participants. So they're not looking to marry these assets. The highest financing is 10-year paper. So they're looking to definitely exit these assets well before that 10-year window. And that's where that 4 to 6 or 5 to 7 year window usually applies. And until then, that's when you have the ability to say, okay, I want to take it all, cash it out, I'll pay taxes, or I want to go back into this property I've had my eyes on the last several months, and so on. But you don't have the flexibility to wake up and make decisions on the portfolio. You forfeit that. It's now in someone else's hands. And you also don't have the ability to just liquidate the asset at any time. But to give you some peace of mind, for lack of a better term, you're in bed with some of the largest realtor organizations, which are known as landlords to corporate America. So when the Walmarts or your Whole Foods or your CVS's, and when you patronize these on a daily basis around your respective neighborhood, 9 times out of 10, those companies do not own the real estate they're in. It's too expensive. They rather focus on what they do best. They do groceries. CVS is a pharmaceutical giant. They're not looking to be in the real estate business. So they farm that out to the big realtor companies, and they say, you know what, we're looking to put down 50, 100 stores next year. Find us some locations. We want to be close to urban areas. We want to be in suburbia. We want to be in downtowns. They find those areas and they just come in, sign a 10, 15, 20-year lease, and they spend the money on putting their team together, providing the supplies and the product in the CVS, in the grocery store, et cetera. And they just write a monthly check to be a tenant. And it gives them much more flexibility, frees up more capital to put down more locations, as opposed to concentrating on buying the land, building the structure, putting the personnel in there and the product in there. That's like a quadruple of expenses. So you cut down 2 of those big expenses and you concentrate on what you do best. So these are the kind of companies you're basically teaming up with to provide you the DST portfolio and the income that you're needing.
Got it. So would you say that the negatives are, 1, liquidity, and 2, which is also a positive, that you no longer have control of the asset? Meaning, like, I've got some clients that are like, almost like, I don't want to lose that control. And if that's the case, you'll probably make a different recommendation. So you may say, hey, invest it in a triple net property instead, where it's not a DST, or you may say maybe an UPREIT or something different, or not an UPREIT, just something different. Basically, at that point, you'll probably make a different recommendation.
Yeah,
What was liquidity is one of them? Control, was that the second one, or what was the 2 things that you said that
I
are
think
negative
those are
about
the
DST?
2. Control, if you're talking to someone and they really are reluctant to give up the control, then the DST world might not be suitable for them, because they love to get the calls. They love to the hands-on approach to owning and managing, and that's fine. And then of course the liquidity piece is a big one, and that's why it's key when I get a call about a prospect or so on. I want to know, what kind of liquidity do they have? Do they have brokerage assets elsewhere? Do they have bank deposits? Do they have a pension coming in, et cetera? Because we want to dissect that situation, so we can know, okay, maybe you should retain some dollars. And if I get involved early enough in the situation, someone is looking to sell, and we find out they might need liquidity. This is a way you can, as a realtor, and the realtors who are out there, you can get that client to get a line of credit and get a HELOC on the property. If they have ample equity, $1 million owned free and clear, they can go to the bank, go to a third party, hard money, whatever, for 300,000. You sell that property, that 700,000 now can go into a portfolio, and during the escrow process, that 300,000 gets paid off to the lender, and now they have 300,000 basically tax free, because they took the equity out before it sold, and the 700,000 that was left after that million came into a DST portfolio, which then absorbed the debt that they took out. So now you're sitting pretty because you took 300,000 out. It's sitting in your bank. The asset is sold. Equity goes into a DST portfolio with an LTV that's equal or greater to what you took out. So now, bam, you have the best of both worlds. You have 300,000 basically tax-free money. And the DST now, that 700,000 is also providing you cash flow income, and it absorbed the debt that you took out with a HELOC before your property was sold. So those are
So
some of the
basically, there's a way to
nuances
get
that can be
money.
done. Say again?
There's a way to get money without paying any taxes by doing a cash out refinance. Now, the only caveat that I've heard about that, and I'd like to get your input, is I had an accountant tell me that if you're going to do that, not to do it right before you do the 1031 exchange, because then it could look like you basically did that on purpose to basically receive tax-free money. The tax accountant actually recommended that if you're going to do that, to do it a year later, not immediately before, just in case you ever got audited. It didn't look like that was the sole intent of you taking out the money in order to do that. What are your thoughts on that?
My thoughts, it depends on your tax person. However, ideally, if you can take it out beforehand and let it season a little bit, you paid some
Better.
interest along the way, and then you put the property up for sale a year later. That's the ideal scenario, and that's perfect. I would concur with your account.
Accountant.
But certainly, if someone within a 6 month period is contemplating selling and they have lots of equity, they could certainly get the paperwork going to pull some equity out, and then it sells 6 months later, and the DST absorbs that debt. Those are the rules as far as the 1031 allows in terms of the absorption of the debt. You've taken the HELOC out, so I think you should be in good order. But yeah,
Good.
if it's kind of too close, it can look kind of suspect. But you would want to certainly discuss it and strategize beforehand.
Got it. Now, does the income ever increase over time? Like, let's say I'm starting to earn a 5%. I own a traditional property. In a traditional property, rents can go up over time. Does that ever happen in the DST world where my the amount of monthly income that I'm receiving goes up in the same fund, not in a different fund?
Yes, it can happen. Like I said earlier, you are entitled to any increases in cash flow, et cetera.
Got it.
The way they do it, if they meet certain projections, you get 12 checks monthly, and then if they meet certain projections, you might get a 13th check in terms of for that year. And in some cases, I've seen this in self-storage portfolios. I've had clients, even during the pandemic, one client sold a Bakersfield single-family rental and lives back east. And she was getting tired of having to be bothered with it, especially being that far away. So we sold that and put the assets in several portfolios. One was a self-storage portfolio. During the height of the pandemic, I got the email saying that this portfolio is meeting our projections. Therefore, your 5.15 dividend is going to be increased to 7.2. Talk about a nice letter to get, especially when you have talk about rising inflation and all of that. And then on April 1 will be your higher monthly dividend, that kind of thing. So yes, you do participate in the cash flow increases. And the opposite is also true. You will have, if during COVID, we had a situation where a client of mine sold a Santa Monica property for $3 million. And of those dollars, we put $500,000 in a Las Vegas multifamily. This was May of 2018. Fast forward to the pandemic, the crisis, and so on. The dividend was cut from 5% to 4.5%, and that 0.5 went into reserves. And then fast forward April 21, the portfolio was sold. we got an email saying this portfolio is in escrow. It's being sold for 88.5 million. Cantor Fitzgerald, the provider of this portfolio, brought it to market or bought it in 2018 for 62, 63 million. So the client's half a million became 679,000, including 64,000 of income. And I use that as a good redacted statement to show clients what a closing statement will look like on the buy of a
Mhm.
DST and what it looks like on the sale of a DST, just so they can have some sense of what they might look like when they do a DST.
Got it. I love it. Okay. So I heard this from a client. I don't know if it's true. I want to get your opinion on it. How did DSTs get affected pre interest rates increasing? Like obviously when they did their numbers, and a lot of the commercial world has shorter term financing, some of it goes up depending on rates go up. How were DSTs affected during that time frame? And what are some of the different risk, or yeah, just how were they affected, if anything at all? Did you see like any effects on the industry at that point? And do you have any advice to maybe somebody that went through that?
Yeah, so they were definitely affected. There was a really disconnect or just a wrench thrown into the system when the spike of interest rates and so on. A lot of the big institutional banks who lend to big institutional owners of real estate kind of closed the door, or there was a big spike in the 10-year financing and so on. So a lot of things kind of we saw portfolios became a little smaller with less debt to kind of make up for that squeeze. Then it took several months to kind of get that situation straightened out because just like everyone else, the hiccup that was thrown in with COVID and the anxiety of not knowing how that's going to really help or hurt the finance markets and so on caused a lot of trepidation. But once it over the maybe 2 to 3 month period, and there was talk of a vaccine and things like that, things started to kind of quiet down, and financing was still a little more difficult for your average person, but the institutional buyer was still able to get some financing. Their portfolios became a little smaller, and instead of $100 million portfolio, it might have been $50 million portfolio. But once that kind of quieted down, they're now back in sync in terms of the size of their portfolios. They're still doing the 10-year paper. Of course, rates are higher on that financing now than they were back in 2019 before the pandemic. But so that's what we're seeing or did see. No one really exited the space because of it. They might have slowed down in terms of the portfolios as the frequency that they came to market with portfolios because they really had to shop around for financing more so than they did before.
Got it. Okay, so let's just quickly talk about like underwriting. So if I'm buying a commercial building or if I'm buying a rental property, obviously I'm underwriting the numbers. What advice can you give to people looking at the different asset classes as it relates to how do you know if that's the right investment for you as an individual?
Yeah, so in the DST world, to mitigate the economic uncertainties that can come up and the COVID impact and so on, they try to streamline the type of areas they're going to go after. So, number one, essential services. They're going to be in the needs base versus the wants. So if someone is doing a DST and a realtor asks them, "Oh, do you want to do a physical property? I have a property in North Carolina, etc." Ask yourself, is it in the needs category or the wants? And if it's in the needs category, grocery, CVS's, advanced auto parts, auto zones, these are needs based, regardless of COVID or no COVID, or regardless of bad economy, up down economy, you need to feed your family. You need to get your prescription for your parents or your mom or your son or your daughter. You need to fix your car if it's broken. These are needs based. And if you look at the portfolios that are in the DST world, or at least that I have access to, they are in that needs based category. The wants side of that category, you might want some shoes, a new dress, a TV at Best Buy. You don't need those, however. You can go without them. So, who are the first to see a softening in their sales when crisis happens? It's the wants side of the category. And so you stay away from the want side and you stay with the need side, you have a better chance of having success and being able to ride out the bumpy storms that can come. And then in the multifamily space, you can have some situations where you have oversupply of multifamily in an area that can kind of squeeze the rent roll, or you have a lot of incentives to get clients to come into those units. So you want to stick with student housing is a great space because there's no long-term leases. Mom and dad are on the lease. So if junior acts up, you're not chasing him or her down for rent checks. You're basically dinging mom and dad's checking account on a monthly basis for the rent. And there's more turnover in that space. Grad students graduate, new freshmen come in, or sophomores. So, freshmen were on the dorms. Now they want their own unit with their roommates and friends, and now they're kind of stepping up a little bit. So that's a good niche within the multifamily space. Senior living as well as a good niche within the multifamily space because you have a captive audience. When they're there, they're not really going anywhere for the most part. They're not signing 1 year leases. They're basically is almost their last stop because they need acute care, they need certain specialty services, and so on. So those are very sticky. And I've had clients who, as their parents age, they were put up in swanky Santa Monica senior housing, which was like 8 grand or more a month. And so these things are very attractive, that senior housing space. The traditional multifamily, you want to certainly stay within the A class type properties, the fully amenitized properties, the rooftop pool, the dog park, and the grilling station, and so on. Why? Because they tend to attract the more skilled worker, that worker who can roll out of bed during COVID and turn on their Zoom and still be productive and get a check. So in the B and C class categories of multifamily, they attract more of the service workers that were impacted during COVID, the movie theater worker, the restaurant waitress or waiter, and so on and so forth. So the trickle down effect happened when COVID happened. Those industries were closed because they were not deemed essential. They were basically luxuries. And the powers that be said, we don't need to be in the movie theaters now because COVID is spreading, et cetera. So close, bam. So those people who were in those properties ended up calling their landlord, I've been laid off, I'm not going to be able to pay the rent, et cetera. So you stay away from the B, C type properties in multifamily. In the DST world, they specifically seek out the A type amenitized, fully amenitized properties sitting close to universities, employment zones, and so on.
Got it. Okay. So basically, try to find things that are essential services because in a worst case type of scenario, those would generally perform better. Are there minimum investment size versus maximum? Like, if I had a $20,000 gain, could I invest that, or what do you see typically as the minimum, and what do you
Yeah,
see
the
typically
minimums
as the
on most
maximum?
portfolios is 100,000 to come
Got
into
it.
a portfolio on a DST transaction. There's no quote unquote maximum. However, if someone has a large enough transaction, then they have the scale to pick up where I would pick up the phone and speak to one of the DST providers and they can structure their own type of DST portfolio as opposed to just picking from what's available because of their size. So they do have some flexibility if they have a sizable transaction, but there's no, they won't turn down as long as it's taxable proceeds that will be subject to big capital gains, they can certainly have a DST to provide a relief.
Are there any benefits to doing a single DST versus multiple DSTs? And what are the drawbacks of doing a single versus multiple?
Well, the benefits is very similar to putting a stock portfolio together. Uh, you might like Apple or IBM or whatever, but okay, you're $1 million in that one stock, even though it's a great company and so on. You want some diversification, and that's where the multiple properties and the DST comes in. So instead of that million going into one net lease property in North Carolina or what have you want to spread your risk amongst multiple properties, multiple asset classes, and that gives you better peace of mind. And one of the drawbacks with clients owning one property, and I come across this from time to time, a client, a client I was speaking to sold a rental unit in Sherman Oaks. He was basically hard pressed to find a property, and he's dumped $1.8 million into a Dollar General in North Carolina, and then he was having buyer's remorse 6 months, 8 months after, and so he wanted me to look into that particular property. So I forward that property's address to one of the DST providers. That's all they do is net lease properties, Dollar Generals, Advanced Auto Parts, all these kind of companies, and they looked at that and they said, you know what? That doesn't pass their first check, which is population density around that particular facility. They want to see at least a 50,000 or more population density within a 3 to 5 mile radius from that physical location. If the population density doesn't match up to that number, they're not even going any further in terms of their due diligence. So that's something to ask yourself as an individual. If you're looking to do a one-off property, what's the population density of that location? And it should be, just take it from the institutional buyers, 50,000 or more. That means you have more of a population to drive demand to that location as opposed to just a smaller population, which might mean your revenues or sales are not improving. And then that property becomes a low hanging fruit to not re up the lease when it comes due. And so you often hear that XYZ Corporation is cutting the 10% tile of underperforming stores and so on. And that store that you own could be one of those. And you don't want to be in that 10% lower bottom five. You want to be in the top 20%.
So a lot of times, if you go out and you invest in a triple net, because you don't have the same criteria as a institutional, there may be more risk associated with it because you're not looking at it from the same lens that they are, where they're looking at a standpoint like, how can we minimize the risk? How do the fees work as it relates to a Delaware statutory trust? Like, meaning, how does somebody get paid? Is it same thing as traditional real estate commissions? Does that vary? How does that work?
So the DST world is a securitized transaction. So someone has to be Series 7 licensed in an advisory financial management role in order to
Mhm.
transact in the DST world. The DST sponsors themselves, they charge what's known as a fee on the master lease. So if you have 400 units, 1,000, just to keep the math simple, 400 units, 1,000 a month on a multifamily, they're taking 2 or 3% off the top, and the return they're paying the participants is a cash and cash return. So if it's a 4% dividend and it's $1 million, that's $40,000 cash and cash return. So the dividends that are quoted in a DST world, they're after any expenses. They're taking that spread between what they're paying you and what they're actually receiving, that spread is going to the house. So unlike a traditional brokerage transaction where you get a closing statement, it shows your commission for the agent, the escrow fees, title fees, etc. You don't see those kind of information on a closing statement for a DST portfolio because they're not really, they're present, but your million is still coming in, and you're earning the 4 or 5% on that million. Upon disposition of that portfolio, if it did a 10% return or 20%, you're getting that million and 10% back, and that those proceeds can be rolled over into another portfolio or taken in cash.
Got it. If something bad went wrong with that building, like let's say that for whatever reason it was in a lawsuit, or let's say that, God forbid, the building gets foreclosed on, what is the liability of the person investing in the Delaware Statutory Trust, if any?
If that was to happen and I have that building, then you would lose that position that you
That
have in
investment.
that building. But to mitigate that, I've never seen one of the DSC providers have that happen. Sure, a dividend might be cut along the way because of economic conditions and so forth, but I've never seen, especially if you stay with the top players in the space. Inland Group out of Chicago, 56-year-old firm, one of the 7th largest landowners in the country, one of the 8 largest commercial owners in the country. They're the largest owner or landlord to Walmart's, CVS's, and so on, ESPN headquarters, FedEx. So they have a lot of name brand institutional players in their portfolios. So you stay away from the smaller players who are doing deals and don't really have the breadth of financing behind them. So when there's a hiccup in the economy, then they might get a call on their loan from the bank because XYZ, they've fallen below some of the thresholds that the bank has put in place. And so the bigger, deeper pocket providers don't run into that problem. As a matter of fact, the crisis that happens during those times, they're looking to cherry pick assets at a discounted price when those environments come up. So number one, stay with the bigger players in the space. Number two, if you're putting assets together on a transaction allocation, look at several asset classes. And not only that, but look geographically as well in terms of diversification. And that kind of helps you to spread your risk amongst the funds.
Got it. Okay. The underwriting package, how little or how big is the underwriting package whenever
Yeah,
somebody
you have
has
a
to do
big
these?
PPM. It tells you every detail of every property. It's almost like 300 plus pages. And when I'm engaging with someone, I email that to them about the portfolio. And you can look down on the cash flow projections, the expense projections, excuse me, et cetera. So those packages are pretty detailed. They've gone out multiple times. They'll even tell you on this location, the the parking lot traffic, how many cars are projected to basically visit that location on any given day or month, etc. They really are analytical, and the population density and all these things they go into, especially when it comes to the essential retail type positions.
I love it. Lyndon, is there anything else that you think would be helpful for somebody considering a Delaware statutory trust? And also, like, if somebody saw value in this, what's the best way for them to connect with you or get in touch with you?
My connects, I don't know if you have the ability to put it on your screen or anything, but my number is 310-283-4147. 310-283-4147. I'm in Los Angeles, California. And what was your other question? Sorry.
Is there anything else that you think would be helpful for somebody considering a Delaware statutory trust, or if there's any final words?
Basically, educate yourself, read up on the space before you actually need it. because people, you engage with people and they say, oh, I'm not selling now, etc. But things happen in life. Someone gets older, they have an ailment, they're less mobile, etc. Their grown kids are living in other states and so on and so forth. So rather than waiting for that time to learn about it, when you're under duress, you're in pain, etc. Learn about it while in your comfort of your home, at your poolside, read about the space, because it's better to know about it when you need it than to not know about it at all. And then you basically throw your hands up and say, I'll just pay the taxes. Meanwhile, you have grown kids and 4 or 6 grandkids. That's a lot of money that can go pass down and leave a legacy, to put those kids through college and so on. So estate planning, keep that money in the estate and pass it down. So yeah, read up on it, and if you contact me, I can certainly give you my email and invite you to lunch and learns that happen around the city: Beverly Hills, Pasadena, La Jolla, Del Mar, Costa Mesa, South Bay, and then Westlake Village. So inland, who I mentioned earlier, the deepest pockets in the space, they have these lunch and learns. They host them, no cost to agents or their clients. They can bring their clients and hear the information. There are other like-minded people in the room with similar questions and so on. And you leave there with a nice meal and some good, solid information. I can't tell you how many times someone has been to those functions, and then 6 months, a year or two goes by. I get a call. Yeah, you spoke to this on this. You invited us to this luncheon some years ago. I have a situation, and they're more informed. They're more comfortable knowing that this is a valid option.
I forgot to ask this. Do you have to be an accredited investor to do a Delaware Statutory Trust, or can anybody do
Yes,
it?
you should. You have to be an accredited meaning $1 million or more in net worth, over and above your primary residence. So someone just selling an Indiana 100,000 or 300,000 property that they bought some years ago for 100, but that's their only asset. They really don't qualify for a Delaware statutory trust, because they're not meeting that $1 million accredited investor threshold.
Got it. Okay. Well, Lyndon, I do want to say thank you for taking the time to be on the show. Today we had Lyndon Grey. We talked about Delaware Statutory Trust. If you're a real estate agent that has a client that wants to simplify their life, they don't want to pay the capital gains, they still want to receive monthly income, this may be a good option for you to present to them. Lyndon's a great person. I had a client that interviewed about 8 different brokers, and the client is very detail oriented, and he spoke very highly of Lyndon. So this is somebody that one of my clients that's very smart has worked with Lyndon. So I do want to say thank you. If you've enjoyed this episode, make sure to hit the subscribe button. If you feel that this episode would be helpful to a friend, make sure to hit the share button and send them a link. Thank you again to our viewers. Until next time.